So the key challenge in front of the industry, then, is to find better ways to make existing capital productive. Bill Kennedy will now discuss the macroeconomic factors framing the reinsurance market rate environment, and also discuss how innovation can be brought to bear to better optimize capital. Bill, as I mentioned previously, joined Guy Carpenter a couple of months ago in July as the CEO of our analytics, capital markets, specialty practices, and advisory groups. Bill has more than 21 years of global capital markets experience, having served as President and Chief Investment Officer of Century Atlantic Capital Management, and several senior-level positions with Citigroup Global Markets. Bill, over to you.
Thank you, Henry, and good afternoon, everyone. It's very good to be with you here at Monte Carlo, my first visit to the Rendez-Vous. Guy Carpenter aims to be our client's most trusted strategic advisor, and fundamental to that strategy is our commitment to investing in analytics and advisory platforms. Our mission is to lead the industry in terms of risk management, information, insight, and innovation. This strategy very much aligns with our clients in helping them to address three strategic questions. First, what is the state of the reinsurance market? Second, how can they optimize capital allocation? And third, how can they maximize earnings power? Chris has already illustrated quite clearly, I think, our expertise and depth of knowledge in terms of our understanding of the reinsurance market. I'd like to spend the next couple of moments talking through both earnings power and capital allocation and provide a macroeconomic framework in which we look at this from an advisory service basis. So let's begin with the first macro theme, first of three that I'm going to be talking about. And the first theme is economic volatility. The chart displayed shows 50 years of global GDP growth in the blue shaded area, overlaid with the 10-year standard deviation, or the volatility of economic growth. So we're not so much focused on year-over-year GDP change, but the second derivative, the volatility of that change from time to time. As the chart clearly indicates, volatility began to pick up in 2003 on a global basis, but with the significant spike in volatility following the financial crisis in 2008 and related to the Great Recession, which we have been suffering through. And as the chart shows, that economic volatility is as high as it has been since the Bretton Woods system collapsed in the early 70s and the oil shock of the late 70s. On its own, higher economic volatility is not necessarily negative. However, this spike in volatility combined with a freeze of the credit markets, regulatory uncertainty, lead to uncertainty and risk aversion for many of our clients, and also has an implication to valuations. So what's important to think about in terms of economic volatility is the decision-making process from our clients as it relates to capital allocation and how it impacts the valuations. And we'll talk about that in a bit more detail in a moment. The second theme that we're discussing with our clients is the global debate regarding disinflationary pressure versus inflationary pressure. It's a very confusing debate today for many reasons. One is because when you look at the current state of the economy globally, disinflationary pressures are quite prevalent. However, that is superimposed on a quite inflationary set of policies at the fiscal and monetary policy level around the world. As we talk about inflation, I think it's important to note that there are pockets of inflationary pressures seen, and this also leads to the confusion. On a geographic basis, there's inflation in the UK and in India, and on an economic segment basis, we see inflation in healthcare, hard commodities, and most recently, soft commodities, including food and grain. The chart on display now gives you an indication of inflation expectations, and from a capital markets perspective, much more important to look not at the published or printed inflation numbers, but the expectations for inflation going forward. And as you can see, the red line representing the US, Germany, France, and Japan, inflation expectations are fairly muted for 1 year out, 2011, and reaching about 2% 5 years out. The blue line representing the inflation expectation in the UK, which is inflation rationale, and the inflation expectations there are very unique to the UK economy. Both the inflationist and the deflationist use this chart to argue their case, and thus leading to some of the confusion. Guy Carpenter, our view is that the weight of the evidence points to continued disinflationary pressure in the global market. This is part and due to credit market dysfunction. Second, consumer balance sheets, particularly in the United States, continue to be stretched, and the deleveraging effect at the consumer level and banking level continues, in addition to unemployment. So what does all this mean for the reinsurance industry? Well, as Chris has noted, diminished pricing is leading to a challenged state for the global reinsurance market. Similarly, diminished pricing at a macroeconomic level is leading to disinflationary challenges. So our view is that against this structural backdrop, global economic growth and reinsurance pricing may remain far weaker for far longer than normal. Our final macro theme is capital allocation. Now, capital allocation is both a big picture issue and a little issue. And let me talk about the big picture issue first. And I want to do this in the context of the sovereign debt risk that exists in the world today. And I don't want to talk about Greece, and I don't want to talk about Spain, but I do want to talk about the United States. This chart represents a long-term history of the impact or the return on investment from lending money to the United States. So the blue panel represents the change in US government debt from 1949 until the present day. The purple chart is representing the change in US GDP for that same period. The dashed line that you see represents effectively the return on the dollar for every dollar of debt issued, the return on GDP related to that debt issuance. As you can see in the post-war period, a dollar of debt from the US generated roughly 70 to 75 cents of GDP return. That has diminished considerably over the period of years, and most recently in 2009 and even in 2010, that dollar of debt is only returning about 17 cents of GDP growth. Not a very attractive return on investment. But herein lies the risk from an asset allocation perspective, and one of the major macro risks for our clients, those who are invested heavily in the US Treasury market, with 10-year Treasury rates ranging about 2.7%. We have entered into an era moving away from risk-free return to return-free risk. Similarly, capital allocation decisions are very important at the micro level, and this is certainly the case with our clients. On the whole, the industry has been conserving capital and conserving cash. Not an imprudent strategy or policy in our viewpoint, given the backdrop of a challenged underwriting market, increased economic volatility, and dislocations in interest rates and global risk markets around the world. The slide here gives a representation of the cash balances and how they've built up since 2000. You'll see that they continue to be quite high. The one point to make, in the next couple of slides that I'm going to go through, is talking about the market's reaction to capital allocation for P&C and the reinsurance carriers. The issue here is, if you look at the red dot, which represents the PE ratio, is that there seems to be a derating of our industry and a derating of the carriers in a wholesale fashion. This slide represents the price to book of major carriers, P&C and reinsurers, relative to consensus ROE. Now, historically, low price to book to relative ROE has been a very good indicator of M&A activity. When stocks trade cheap relative to their ROE, that is to say, when the shaded area of this chart becomes quite crowded with all the blue dots placed there, as they are today, it's usually a precursor to M&A activity in the industry. But here's the market paradox today. Short-term investors are demanding our clients do something with all of the excess capital. Client firms' ability to do something, however, is impeded by low equity valuations, making the M&A currency too cheap and acquisitions too expensive. So we have to ask the question, is the industry being unfairly punished by the investment community? Our view is yes. The last slide, also pointing to the valuation story, as you can see on a price-to-book basis, the industry today is trading at a 2 standard deviation below the long-term average. So why has the investment community derated the group? First, we think depressed valuations reflect increased economic volatility, as we've discussed, as well as volatility at the individual line of business level. Most importantly, however, we think historically low valuations represent a misperception in the investment community that P&C and reinsurance players are poor allocators of capital. Again, we disagree. Even good companies with proven capital discipline have been painted with the same brush and been derated by the market. This last slide illustrates 31 different P&C and reinsurance carriers, and what the bars represent is the difference between the capital returns and the cost of capital. What stands out is that over 70% of the major carriers' returns have exceeded their cost of capital. In other words, most firms are indeed adding to shareholder value. These are fairly impressive results, particularly against a backdrop of higher economic volatility and the soft reinsurance market. So our takeaway from the capital allocation discussion is, first, we disagree with the market that the P&C and reinsurance firms are poor allocators of capital. The data would prove otherwise. Second, as we mentioned earlier, with so much excess capital in the marketplace, carriers should be looking for value accretive and value-added opportunities to deploy capital rather than sending it back and sacrificing long-term returns. Third, within this market, reinsurance represents a relatively flexible, low-cost third form of capital that can assist our clients in managing the risk and sustaining long-term earnings power. So as I mentioned at the outset, we are very much committed to leading the industry in terms of risk management, information, insight, and innovation. This is one of the many reasons I joined Guy Carpenter, a firm with a long, proven track record of innovation in the reinsurance industry, as evidenced by many of our industry-leading products and solutions, including MetaRisk, iAxis, and most recent introduction of CASCAT, the industry's first casualty cat advisory offering. Already, planning is underway within the firm on development of Guy Carpenter's proprietary next-generation analytics platform, bringing together integrated R&D, innovative applied analytics, plus leading-edge capital and financial advisory services to help deliver one Guy Carpenter to our clients. It's a privilege to be a part of this firm. It's a privilege to be a part of this executive team, and I look forward to working with you over the years. Thank you very much for your time, and I'll yield back to Henry.